Federal crop insurance is one of the most successful programs in history. It's a public-private partnership, so it allows for farmers to be financially backstopped by the risk management agency, but it allows for effective, competitive private sector delivery. However, a few challenges remain. Multi-peril crop insurance doesn't always track with actual financial losses on the farm. There's a couple of reasons for this. First, and probably most importantly, the harvest price and projected prices in multi-peril crop insurance don't capture basis. Basis is a very significant part of farmers' financial risk, and from year to year, actual situations on the ground in terms of revenue, yield, price don't always match a farmer's financial loss. There's a few ways to address this. We believe the most effective way is a private insurance product called Production Cost Insurance, or PCI. PCI was developed by Global Ag Risk Solutions. PCI is a revenue insurance product. It uses a 5-year average revenue benchmark minus 5 years of input costs to calculate the base guarantee. At the beginning of the year, a farmer's guarantee is equal to this base benchmark gross margin. When the producer begins spending on seed, fertilizer, chemical, or hedging, the guarantee slides up at no additional cost. It's a good risk. After all, if a farmer's crop is bad, is he going to put additional fertilizer on? Similarly, if a farmer's crop is bad, is he going to go sell it forward? Probably not. The fact is, simply put, PCI allows farmers to farm like it's the best year they've ever had. Like the crop looks great, like the weather outlook is good, like the market is up, and they can go sell forward and fertilize for the best crop that they have ever had. Farmers' rates are set by mathematicians called actuaries, and they use fairly complex statistics. If that's what determines what farmers' rates are going to be set with, why shouldn't their crop insurance agent use the same mathematical tools? And that's what our proprietary PCI software does. It uses complex algorithms and machine learning techniques to use a farmer's actual production history and simulate thousands of crop years on that farmer's farm. After that, it allows us to generate revenue probabilities. The green line represents revenue probabilities for a farm with multi-peril in place, while the red line represents revenue probabilities with PCI in place. Notice there's about a 15% chance revenue will be less than $500 with multi-peril in place. With PCI in place, the probability that revenue is less than $500 is zero. Actually, the probability that revenue is any less than $580 is zero. Losses are stopped out for this farmer at about $580 because PCI is in place. PCI allows this farmer to farm like it's the best year he's ever had, to sell the crop forward when the market dictates, and to fertilize for those extra few bushels. And that's what allowed this farmer to stop his losses out at $580 with PCI in place. If you have any questions about PCI or would like to use our tool to determine if PCI is a fit for your farm, don't hesitate to give us a call. Send us an email, like us on Facebook, or reach out to us on Twitter.